Good evening, everyone. It is August 11th, Tuesday, and about 9:40 in the evening. I want to do the TET articles in the portfolio readings tonight. It will be a short lecture tonight. My mind is very tired. I had a really busy day doing umpteen different things. And then tomorrow, I'm going to do the summer's book review article on The House of Debt by Amir Sufi and Atif Mian. And that one is a major, major article, and I urge you all to look at every part of it. So we want to look at the TET article, The Shadow Banking World's Implosion is the Real Culprit. Gillian Tett is perhaps the foremost columnist, foremost writer in the Financial Times. I've met her and she's a very, very sharp lady. And she has really insightful articles that she writes. But the one I'm referring to tonight is an April, April 24, 2009 article in the Financial Times. And she's saying that if you take a look at some new data crunched by Citicorp, Citigroup, really, it might seem that it's unfair for the banks to have been blamed for the Great Recession, that is, for unleashing the disaster and for the credit crunch which followed it. Citicorp's data shows gives a different explanation of the credit crunch. It was not the collapse of bank loans that led to the Great Recession, but really the implosion of the shadow banking world. So, and if you want to know exactly what the shadow banking world is, read the Rubini article in this portfolio of readings. There are many parts to it. And she said that, in so many words, the reduction in loans occurred in the shadow banking area as opposed to banks themselves. She says that according to the city data, almost $1.5 trillion worth of new corporate loans were issued across the global financial system in 2008. And this was well down from 2007's, this was down from 2007's figure of over $2 trillion of loans. But the loan total in 2008 was similar to what it was in 2006 and twice the scale of activity in 2004. Moreover, when non-financial loans are measured, an even more notable pattern crops up. At the end of last year, that is 2008, the volume of non-financial corporate loans was still growing at an annual rate of 10% in both the US and Europe. That was well below the 20% expansion seen in Europe before the peak of the boom. And in some sectors, new bank lending has tumbled, but those figures do not point to a credit drought. After all, from 2002 to 2004, loans to the non-finance companies in the US shrank at an annual rate of more than 5%. So everyone, the credit crunch follows the lack of credit, the lack of liquidity, definition 3, was not really the cause of the Great Recession. What is imploding, though, according to Citigroup and geologic data, is the securitization world. And it was imploding If you exclude agency-backed bonds in 2006, banks issued about $1.8 trillion of securities backed by mortgages, credit cards, and other debts. And in 2008, hold on here. I think I attributed the 1.8 trillion to 2008. It was really 2006. In 2006, banks issued 1.8 trillion of securities backed by mortgages, credit cards, and other debts. And last year, meaning the year 2008, a mere 200 billion of bonds were sold in markets. That's 1/5 of $1 trillion. And this year, in 2009, according to Tech, market issuance is minimal. So there was a great big implosion of the amount of credit, if you will, of security-backed mortgages in the years 2006 to 2009. Indeed, the only group really acquiring repackaged debt now, let's try it again. Indeed, the only group really acquiring repackaged debt now are Western central banks, which have taken huge volumes of securities onto their own books and away from the market as part of their liquidity injection measures. So here we have the second transmission mechanism at work. And if you recall, you have Fannie Mae and Freddie Mac. They were government-sponsored enterprises during the Great Recession, but after the Great Recession have become government agencies, and to a lesser extent, Ginnie Mae. They would go into the retail mortgage market and buy 85 to 90% of all mortgages. Let's talk about the time when they're government entities, Fannie Mae and Freddie Mac. 85 to 90% of all retail mortgages, and they would spend all that has been budgeted for them by the government, and they would bring these mortgages back and securitize them. They would rate them by credit quality. You might have 4 or 5 tranches in a securitization, and then everybody, according to the second transmission mechanism, the Fannie Mae, Freddie Mac have only one client, the Federal Reserve. So with direct Federal Reserve money, the Federal Reserve expands its balance sheets by buying the securitization, and the funds for continued intervention in the retail mortgage market are provided by the Federal Reserve to Fannie Mae and Freddie Mac with the purchase of the securitizations. They in turn go right back into the retail mortgage market and continue buying up to 90% of all retail mortgages. So the second monetary transmission mechanism has been very important. The first transmission mechanism, that of with banks and the credit expansion process, was not responsible for the credit crunch, and a lot of people thought the big banks were responsible. So, and you notice there's an emphasis when you read these articles on Hyman Minsky's third phase of the financial crisis, the distress period, financial distress. And this is what most of the articles for 2007, 2008, and into 2009 were concerned with. And of course, the House of Debt picks up the other phases of the Minsky model. And that means we're expanding our description of the Great Recession. And Mian and Sufi make a tremendous contribution, empirical contribution, to the analysis of the Great Recession. They look at the book They look at the credit, they look at the securitizations, all of that, and come up with a alternative analysis than just blaming banks. So what do we want to say? On paper, many of the ideas seem to be sensible, but if they are implemented, they eventually enable the securitization market to return to life, albeit on a more sober scale. But eventually is the key word here. Right now, most parts of the securitization market are all but dead. This is an article in 2009. The longer that the politicians wait about the supposed failure of banks to lend while ignoring the bigger source of the credit crunch, the harder it will be for the system to come back, to get away from government support. So there you have the first article by Tet, and she, if you consider all credit, all money, she was really looking at the inflection point that is happening. It happened in the U.S. economy, and it happened because of the implosion of shadow bank loans and debt. She, in a following article on July 1st, 2011, 2 years later, Chet says that the state is now the dominant force in U.S. capital markets. For the first time, the U.S. government will be the biggest source of outstanding home mortgage and consumer credit loans, home mortgage and consumer credit loans in the U.S., eclipsing the private sector. So, and some figures are given, but you can read this article. It's very, very short, and the big question, a third question she asked is, what will the limits of American sovereign balance sheets be in the future? So anyway, there you have it, that one. And then in the third article, 2013, April 26th article, she says the U.S. mortgage market depends on state support. And it's incredible that it's overwhelming and nobody seeks to change it. The private, capitalism does not reject this support. The bank system became a ward of the federal government, of the Federal Reserve and Treasury in particular. And given our free market tradition, this seems so contradictory to Ted, and she's right. So anyways, take a look at those 3 articles, and tomorrow I will do the House of Debt article. Please read it thoroughly, read it analytically, if you will, and Bob Junkel, you'll be well prepared, probably well prepared for one question at least on the final examination. So I'm going to end this now. Again, there's just 3 articles in there, very short articles by Gillian Tett of the Financial Times, and you want to take a look at those. So I'm going to end this, and let's see. Here we go. And so I wish you all a good evening, and see you tomorrow.